You see a perfect bullish setup on the 15-minute chart. The structure is breaking upwards, and momentum looks flawless. You confidently execute a buy trade, but seconds later, a massive red candlestick violently crashes through your stop loss, destroying your account balance. Why? Because while you were staring at a microscopic uptrend, you blindly traded directly into a massive daily resistance zone. In this masterclass, I will show you exactly how to identify true trends using multi-timeframe analysis, ensuring you never trade against the big banks again. Let us begin by addressing the absolute biggest disease that destroys the accounts of 95% of retail traders: timeframe tunnel vision. When a beginner opens their charting platform, they typically select one specific time frame that they feel comfortable with, usually the 5-minute, 15-minute, or the 1-hour chart. They draw their support and resistance lines, they apply their moving averages and oscillators, and they base their entire financial risk on what that single, isolated view is telling them. This is the equivalent of trying to safely cross a massive, multi-lane highway by looking through a tiny keyhole. Yes, you can see the 2 inches of asphalt directly in front of your eye, but you are completely blind to the massive 18-wheeler truck speeding directly toward you. The Forex market is not a static, two-dimensional picture. It is a highly complex, multi-dimensional ecosystem where different participants with vastly different amounts of capital are operating simultaneously. A massive global hedge fund, a central bank, or an algorithmic trading institution is not looking at the 5-minute chart to decide where to deploy $1 billion. They are making their decisions based on the structural liquidity found on the monthly, weekly, and daily charts. When you look at a beautiful, strong uptrend on a 15-minute chart, you might feel incredibly confident pressing the buy button. But what you do not realize is that if you zoomed out to the 4-hour or daily chart, that entire 15-minute uptrend is nothing more than a microscopic, temporary pullback. And worse, it is driving the price directly into a massive institutional supply zone. The moment the price physically touches that higher time frame supply zone, the institutional algorithms automatically trigger massive sell limit orders. The overwhelming selling pressure completely absorbs and destroys the lower time frame buyers, and the market crashes violently. You sit there staring at your screen, wondering why your technical analysis failed, blaming the market, or thinking your broker manipulated the price. But your technical analysis did not fail. You simply analyzed the wrong dimension. When your micro time frame analysis completely contradicts the macro time frame reality, the macro time frame will always win. The higher the time frame, the more institutional money and time is required to build that structure, which means it holds exponentially more gravitational weight. A single daily resistance level will easily absorb and obliterate a 15-minute uptrend. If you want to survive and achieve consistent long-term profitability, you must completely abandon the habit of trading in a vacuum. You must learn to view the market holistically, understanding exactly where the current price action fits within the grand scheme of institutional order flow. You must learn to read the story from the highest level down to the lowest. Before we dissect the exact top-down framework, we must address execution. A flawless multi-time frame analysis is completely useless if your broker manipulates your entry with high spreads, platform lag, or requotes. That is why I exclusively trade with and highly recommend XM Broker. When I drop down to the 15-minute chart for a sniper entry, my stop loss is incredibly tight. I need military-grade precision. XM is a globally regulated broker that guarantees ultra-low spreads, absolutely zero requotes, and lightning-fast execution, ensuring you enter the market exactly where you planned. Take control of your trading career and click the link in the description to open your XM account today. To master the implementation of multi-time frame analysis, you must first deeply internalize a mathematical truth about price action. The Forex market is entirely fractal. In geometry, a fractal is a never-ending pattern that is self-similar across different scales. If you look at a snowflake under a microscope, the tiny microscopic branches look exactly like the entire snowflake. The financial markets operate on this exact same principle. A head and shoulders pattern on the monthly chart behaves mechanically the same way as a head and shoulders pattern on the 1-minute chart. The rules of supply and demand, support and resistance, and market structure are universal across every single dimension of time. Let us visualize this concept. Imagine a single, massive green, daily candlestick. It has a long wick at the bottom, a massive green body, and a short wick at the top. To a swing trader looking only at the daily chart, it is just one simple, solid block of bullish momentum. But because the market is fractal, that one daily candlestick contains an entire universe of price action inside of it. Since there are 24 hours in a trading day, that single daily candle is made up of exactly 6 4-hour candles. If you drop down to the 4-hour time frame, that long bottom wick of the daily candle was actually a clear, established downtrend on the 4-hour chart. It was making lower lows and lower highs for several hours. Then, when the institutional volume stepped in at the daily low, the 4-hour chart experienced a violent market structure shift, breaking its lower highs and starting a massive uptrend. This massive 4-hour uptrend created the giant green body of the daily candle. If you zoom in even further, those 6 4-hour candles contain 96 15-minute candles. The 15-minute chart inside that day will show entire life cycles of trends, massive intraday impulses, complex pullbacks, consolidations, and liquidity sweeps. What does this mean for you as a trader? It means that a trend is never just a straight line, and a trend is never absolute. The higher timeframe impulse leg is made of lower timeframe trends. The higher timeframe pullback is made of lower timeframe downtrends. When you truly understand this, you stop getting confused when the daily chart is bullish, but the 4-hour chart is bearish. You realize that the 4-hour bearish trend is simply the mechanical way the daily chart is pulling back to gather liquidity. You are no longer looking at conflicting information. You are looking at different chapters of the exact same story. This fractal understanding is the absolute foundation of the top-down approach, which is the mechanical system we will use to extract profits from the market. The top-down approach is a strict, rule-based framework that forces you to align your trades with institutional money. It requires you to select specific timeframes and analyze them from the highest down to the lowest. However, you cannot just click randomly between the monthly chart and the 1-minute chart. If you look at every single time frame available on your platform, you will suffer from total analysis paralysis. You will find so many contradicting trends that you will never be able to execute a trade. To solve this, professional traders rely on a mathematical concept called the rule of 4 to 6. This rule states that the time frames you choose to combine should have a mathematical multiplier of roughly 4 to 6 between them. For example, there are 6 4-hour candles in a daily candle. There are 4 15-minute candles in a 1-hour candle. This specific mathematical gap ensures that you are zooming in enough to see distinct, actionable changes in market structure, but not zooming in so far that the charts become completely disconnected from reality. Furthermore, you should only ever use exactly 3 timeframes. We categorize these 3 charts into 3 specific pillars: the anchor timeframe, the directional timeframe, and the execution timeframe. Let me give you the 3 most powerful timeframe combinations used by institutions. If you are a swing trader, holding positions for days or weeks, your anchor is the weekly chart, your directional map is the daily chart, and your execution is the 4-hour chart. If you are an intraday trader, which is the most common style, your anchor is the daily chart, your directional map is the 4-hour chart, and your execution is the 15-minute chart. Finally, if you are a highly aggressive scalper, taking trades that last only minutes, your anchor is the 4-hour chart, your directional map is the 15-minute chart, and your execution is the 1-minute chart. For the remainder of this comprehensive masterclass, we will focus on the intraday combination, the daily, the 4-hour, and the 15-minute charts. This is the ultimate sweet spot for finding massive risk-to-reward ratios without having to hold trades over the weekend. Let us break down the exact step-by-step mechanical rules for each of these three pillars. Step 1 always begins on the highest time frame, the anchor. In our example, you open the daily chart. When you look at the daily chart, you must completely ignore minor candlestick patterns. You do not care about a daily doji or a minor indicator fluctuation. Your only objective is to map the macro battlefield and answer one fundamental question. Who is currently dominating this asset? Is it the buyers or the sellers? First, you must identify the overall structural bias. Look at the major swing highs and swing lows. Is the daily chart aggressively making higher highs and higher lows? If yes, the macro structure is fundamentally bullish. The bulls have complete control of the macroscopic order flow. The moment you determine this, you must set an unbreakable psychological rule for the rest of your trading session. You are only allowed to look for buy setups. You absolutely forbid yourself from taking short trades, no matter how tempting they look on the smaller time frames. By simply refusing to trade against the daily trend, you will instantly filter out more than half of your losing trades. Once your bias is established, your second task on the daily chart is to locate the major institutional zones. You are looking for massive areas of unmitigated daily demand, historical order blocks, or major structural support levels. Look for the extreme structural swing lows that caused massive, violent upward expansions in the past. You draw thick rectangles around these zones. These zones act as giant magnetic pools for price action. If the current price is hundreds of pips away from your massive daily demand zone, you do nothing. You set an alert and you wait. Amateurs lose their money trying to trade the chaotic dead space in between major zones. Professionals wait for the price to come to them. When the price finally drops and physically touches your daily demand zone, your anchor analysis is complete. The market is now in a highly sensitive, high-probability location, but you still do not enter the trade. Why? Because the daily zone is massive, and trying to catch a falling knife on a daily chart will destroy your account. You need to zoom in. This brings us to step 2, the directional time frame. We drop down from the daily chart to the 4-hour chart. The purpose of the directional time frame is to act as a map. It tells you exactly what phase the daily trend is in, and it confirms whether or not the daily support zone is actually going to hold. Let us continue our scenario. The daily chart is bullish, and the price has just dropped into your daily demand zone. When you open the 4-hour chart, what does that drop look like? It looks like a completely valid, aggressive downtrend. The 4-hour chart has been making lower lows and lower highs for several days to reach this point. This is the exact moment where uneducated retail traders fail. They look at the 4-hour chart, see heavy bearish momentum, and they initiate short sell positions. They are blinded by the lower time frame momentum and completely unaware they are selling directly into a daily institutional buy wall. As a professional, you recognize that this 4-hour downtrend is nothing more than the retracement phase of the daily chart. The market is simply pulling back to a discount level. The institutions are intentionally driving the price down to collect liquidity before the next massive leg up. But even though you know this, you still do not hit the buy button. The 4-hour order flow is still technically bearish. The knife is still falling. If you buy right now, the bearish momentum could easily slice straight through the daily demand zone, and you will be stopped out. Instead, you stalk the market. Your job on the 4-hour chart is simply to monitor the pullback. You want to see the price hit the zone and start losing bearish momentum. You are waiting for the exact moment when the 4-hour sellers run out of gas, and the institutional buyers step in to defend the daily zone. To find the exact microscopic entry point with absolute mathematical precision, we move to the final step. Step 3 is the final piece of the puzzle, the execution time frame. We drop down from the 4-hour chart to the 15-minute chart. The price is currently sitting deep inside our massive daily demand zone. We are looking inside the structure to find the exact microscopic origin point of the massive buying volume. Initially, the 15-minute chart will look highly erratic and bearish as it crashes into the zone. We are waiting for a specific structural pattern called a change of character, commonly known as a CHoCH. We want to see the 15-minute sellers make one final desperate push to the downside, often sweeping liquidity by creating a fake lower low. Suddenly, the institutional buyers activate their massive limit orders. The selling pressure completely evaporates. Massive, aggressive green 15-minute candles violently explode upward, completely destroying the most recent 15-minute lower high. This violent structural break is the absolute mathematical proof that the retracement phase is officially dead, and the massive daily anchor trend is resuming its explosive upward journey. The daily, the 4-hour, and the 15-minute order flow are now pointing in the exact same direction. Total time frame alignment has been achieved. Once the change of character prints, the institutions leave behind a footprint, an unmitigated order block on the 15-minute chart. You wait for a tiny, quiet pullback directly into that freshly created 15-minute demand base. You place your buy limit order exactly at the top of the zone. You place your stop loss just a few pips below the 15-minute swing low. Because you are entering on such a low time frame, your stop loss might only be 10 or 12 pips wide. But where is your target? You do not target a 15-minute high. You target the next massive liquidity pool on the daily chart. This is where risk management becomes effortless. Because your stop loss is so incredibly tight, every single pip in your favor generates a massive return. You are risking 10 pips to make 150. That is a 1 to 15 risk to reward ratio. You can literally lose 7 out of 10 trades, and because your multi-timeframe winners are so massive, you will still generate consistent generational wealth at the end of every month. You are no longer gambling on 15-minute noise. You are sniping macro institutional trends. Understanding this perfect alignment is powerful, but possessing the psychological discipline to act only when it happens is what separates the top 1% of traders from everyone else. What happens when the market does not present you with a perfect unified story? What if your daily chart is bullish, your 4-hour chart is bearish, but your 15-minute chart suddenly turns bullish before it ever hits your major daily demand zone? When your time frames are in a state of contradiction, the market is trapped in a chaotic, low-probability environment. Institutions are fighting for liquidity, and the market will be full of fake breakouts, stop hunts, and massive volatility spikes. If you force a trade in this environment, you are essentially flipping a coin. When time frames conflict, there is only one professional protocol. You sit on your hands and you do absolutely nothing. You close your trading platform and go for a walk. In trading, cash is a position. Protecting your capital during hostile market conditions is arguably more important than making profits during favorable conditions. Professional traders operate like elite snipers. They wait patiently for all the variables to align perfectly, and only then, with absolute certainty, do they pull the trigger. Let us summarize the ultimate blueprint for mastering market direction. Never fall into the trap of timeframe tunnel vision. Trading a single chart is trading blind. Always embrace the fractal nature of the market and utilize a strict top-down approach. Start with your macro anchor chart to define the dominant trend and massive institutional zones. Step down to your directional time frame to identify the pullback phase. Finally, zoom into your execution time frame to find a precise change of character that allows you to risk pennies to make dollars. When you patiently wait for all 3 time frames to perfectly align, you stop fighting the current and start riding the tsunami. You trade less, but you win significantly more. If this deep dive into multi-timeframe analysis transformed the way you view the charts, hit the like button, subscribe to the channel, and ensure you check out XM Broker via the link in the description for flawless, professional-grade execution. Master your timeframes, control your patience, and I will see you in the next masterclass.